The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box with Juliana Tattelbaum, who I will try to assist. I'm Steve Sedgwick. These are your headlines. Okay, breaking news on UK GDP. A whole set of data coming out, but really disappointing. October GDP, negative 0.1% month on month. The poll was for up 0.1% again. Once again, really underwhelming GDP out of the United Kingdom, with services output in October down 0.3%. This is the first figures since the country's budget crossing the wires and ahead of that crucial Bank of England decision next week. Concerns over an AI spending spree send Oracle shares to their lowest level since January, but global stocks hit fresh record highs, with the S&P 500 closing above 6,900 for the first time.
Disney inks a $1 billion deal with OpenAI, licensing its characters to be used in the Sora video creation app as the ChatGPT maker looks to cement its position in the AI race.
Morning, JT. How are you?
Morning. Yeah, doing
Happy
well.
Friday. Are you going to the CNBC Christmas party tonight?
I wouldn't miss it.
I wouldn't miss it
you.
either. I've got Reformer
see.
Pilates in the afternoon. I can't do both. Genuinely. We have the data out, and as I mentioned in the headline, this is underwhelming. What a soggy lot of growth the UK has at the moment. I mean, shall I go through a bit more of it as well? The GDP output in the UK year on year up 1.1%. The Reuters poll had us as high as a mighty 1.4% as well. So underwhelming there. Slightly better industrial output in the month of October, up 1.1% versus Reuters poll of 0.7%. But by and large, the output figure underwhelming. Construction underwhelming. In fact, construction, negative 0.6 month on month. The poll was for 0 as well. Services output, negative 0.3% month on month. Any ideas why, everybody? This is the government that promised us economic growth. Any ideas why people didn't want to spend money? People didn't want to invest. People didn't want to start plant. People didn't want to put more money into infrastructure when we were waiting for a budget that was delayed, when rumours going around and there were leaks galore, some of which the Treasury might even admit were theirs, and had just come out on November 26. I'm sorry, this is not rocket science. If you make people concerned about their personal wealth, about their corporate wealth, about what's going on a broader basis, of course they're not going to conduct extra activity.
I think GDP is always somewhat of a backward-looking indicator, and in this case, to your point,
isn't
clearly,
all data a backward-looking indicator?
Well, it depends. Survey data,
it's
how people are
accumulated,
feeling.
and then we release it. You can't.
I think some of it is the survey data is arguably forward-looking. It's how people are thinking about the future. But when it comes to GDP, this is hard data that is backward-looking. It captures what's happened in terms of economic activity. And to your point, clearly there was an impact of the budget uncertainty on business investment, on manufacturing, on sectors across the UK. I think the real test here is going to be, now that we know what the government plans to do with its budget, is it going to unlock growth? And looking at what the BCC had to say yesterday, not a lot of optimism around the growth it's going to kickstart.
I'll tell you what, here's one for all you Brits out there, or for anyone out there. Steve.Sedgwick@cnbc.com. I want you to message me if you see anything that's more positive about the UK economy because of government policy. There you go. And I meet a lot of people. We speak to a lot of people every single day, on camera, off camera. I want to be positive. I want to end Friday on a positive note. You tell me if you see something more positive than I'm saying, and I will put my hands up and say I was wrong, okay? Because I'm really worried that people are just losing the will to invest extra money because of government policy in the UK. The people are going to invest regardless. People are going to put money into their businesses. But I just want to hear someone who thinks actually the government's doing a good job. Okay, there's a task for you this morning. In the meantime, US markets.
Let's take a look at Wall Street and the action that we saw yesterday. We are looking at the Dow Jones, 1.3% higher for the session. That was the lead in the U.S. We saw a lot of demand for material stocks yesterday, as well as some of the consumer stocks in the U.S. This was not a tech story yesterday, which stands in contrast to the trade we've seen throughout much of the year. The Nasdaq actually closed lower by about 0.25%. Now, at this time yesterday, we were looking at a negative start to trade in the U.S. Futures were negative, and things got off on the back foot after Oracle numbers were released the night before. Here's a look at how Oracle shares ended up faring yesterday. The stock closed down just about 10%, weighing on the overall tech sector. So the leadership was certainly interesting yesterday, and a change of pace from what we've seen in recent trade, with tech not leading the way higher in the U.S. Now, in terms of Asian markets, here's the current picture. You've got gains across the board. The Hang Seng up 1.6%, the Nikkei 225 up by about 1.4%, the Shanghai Composite over in mainland China up about 1/3%, and strong gains in the Korean market. In terms of European trade, here's your early look. We are close to an hour away, so still some time to go, but we're looking at a decent start to trade on this Friday morning here in Europe. This follows a strong day yesterday. The Stoxx 600 gained 0.6%. It was the best daily performance for the main benchmark here since the end of November. All the major regions in Europe gained ground. Finally, in terms of U.S. futures, here's your indication. More of the same from what we saw yesterday. We're looking at more gains for the Dow, more than 100 points higher indicated at this stage, and more of a pullback for the Nasdaq. Fairly contained in terms of the magnitude, but a pullback nevertheless.
Okay, let's get to Bill Mann, CIO at Motley Fool AM. I think he's joining us out of Virginia. Nice to see you, sir. Thank you very much indeed for joining us, Bill. Bill, do you think market levels at the moment, by and large, are anchored in the real world, or actually is there too much speculation which is taking valuations to the wrong level?
Can it be both, actually? One of the things that we've seen in the U.S. is obviously we are just coming off of a Fed rate cut of 25 basis points. It was very much a divided opinion, in fact, somewhat historically so. The U.S. market is really being driven by three things right now, and only three things. It's affluent spending, asset price appreciation, and AI build out. So when you see the Fed deciding to cut rates, they're really worried about the remainder of the economy. And so it's a very narrow economy being driven by very few things. What we might call the S&P 493, it really needs a chance to catch up. So it really is a little bit of both, a very, very narrow, very concentrated market here in the United States.
Yeah, I love that answer, Bill. Look, let's look at the rest of the spending, though. You mentioned the 493 and the 7. I feel like that's what you're talking about with your comment as well. The affluent spending maybe be the 7. What about the rest of the US, though, and the bottom leg of that K that people keep telling me about?
Yeah, I think that there's a great deal of concern in Middle America here. We see we see, for example, the amount of layoffs and job reductions here in the U.S. is at a record for 2025. And even though that's not showing up in the top line number, again, that's being driven by very few things. And so when the Fed got together the other day, and you saw comments, there were Fed governors who were looking for a larger cut, and some who didn't want any at all. And we're hearing from the comments even more division within the Fed. And it just has to do with the fact that there are so few things that are driving growth. So we at Motley Fool Asset Management don't tend to get too excited about one day responses, but it would be kind of a Goldilocks response for the Federal Reserve for the NASDAQ prices to be coming down a little bit while the remainder of the market, starting with material stocks, are going the opposite direction.
Bill, one of the three factors that you've highlighted there is propping up the U.S. economy's asset appreciation. If we were to see a more sustained downturn in U.S. equities, and so far it doesn't seem like that's on the horizon, investors just continue to buy any weakness that has come through. But how impactful is the wealth effect right now, given the impact that asset appreciation has had on spending in the U.S.?
I think it's been massive. I mean, you've already had spending in the area of $250 billion in the AI space, and you are seeing a market here that is as concentrated within one industry and within the top companies as it has ever been. So when we think about market levels, if you would like a solution to that, if that's something that you need, there's only two ways to get it. One is for the remainder of the US market to rise faster than tech companies, or for the tech companies to fall faster than the rest of the market. And I know which one of those I would prefer. I would rather have the rest of the market going up, and that has to, that has to happen with consumer spending across the board. It can't just be driven by asset appreciation in a very narrow set of assets.
Bill, on that note, yesterday, and I don't want to extrapolate too much, but yesterday, notably, the leadership in the U.S. market didn't come from tech. We actually saw a renewal in appetite for some consumer stocks, among others, including materials. But you seem to be constructive in part on the consumer sector. I see TJX is one of your top picks from a stock perspective. How are you thinking about the U.S. consumer and, in particular, consumer stocks here?
Yeah, TJX is one of the companies that's in a number of the Motley Fool asset management ETFs, and it's a company that we've long admired. One of the very interesting things about the owner of TK Maxx is the fact that almost none of its supplies and almost none of its the goods that it is buying as a closeout retailer are from outside of the United States. About 90% of its of the things that it is buying as a closeout retailer are already here in the United States. So it is not. It does not have the same level of exposure to tariffs that its competitors do. And tariffs, although it's a policy here that is, that is driven around reshoring. Into the United States by the Trump administration, it's really nice to find a retailer that has some immunity to that, and so it's a company that we're very constructive about.
Interesting. And speaking about immunity and unique immunity, looking at Costco numbers yesterday, was reminded about their big private label line, Kirkland, which gives them a lot of flexibility over their supply chain, gives them a little bit of immunity on the tariff front too, it seems. But what about the broader consumer space? Consumer staples in particular have had quite a tough run in the U.S. Any reason to be turning more bullish on the staples here in your view?
Well, I mean, one of the things that is, I think, important in terms of the staples is the fact that with these Fed cuts, that larger spending and spending on bigger tickets items are the exact type of things that they are trying to bring about and trying to emphasize. And so I am hopeful. Again, it has been a very narrow market, and consumer staples have done rather poorly in the U.S., both from a market and from an economic perspective over the last 2 years. And so it is obviously an area that the Federal Reserve Board is looking at in terms of spending as being a sign of more health in the U.S. market.
Hey, Bill, I just wonder if you've got a view on the big story in tech of the last couple of days, and that is underwhelming performance from Oracle. There's great backlog of sales, but people are slightly concerned about the spending and what they're going to get from AI ultimately as well. Does that story represent anything bigger? You talked about the 7 versus the 497.
Yes, and so you could make you could declare Oracle to be a non-official member of the Mag 7. I would say that it is a sign. Obviously Oracle has had an incredible run as a company that is directly benefiting from AI spend. There are signs on the horizon that things really need to happen in terms of cash flows, and there are big questions here in terms of the timing of the cash flows in terms of AI. So when you have that level of spending, it's not just so much that the end result is what it's going to be. It's the timing of it. And so the spending that is in that market is driven by a lot of things that are outside of the control of really anybody, and even coming down to availability of cheap electricity. And so when you see a company like Oracle having the having the results and having the response that its stock has had, it's really a sign that people are looking at the level of spending and saying, okay, where's the cash flow going to come from, and more importantly, when and what the tenor of it is going to be.
Love the conversation, Bill. And I see you're a bit of an Anglophile. Abbey Road, Newcastle Brown Ale. What's that all about?
Well, I am a Newcastle United fan. I've been for my entire life. But yes, that is. I am a bit of an Anglophile, and I hope to see you all there sometime soon.
I would love that very much. And unfortunately, being a Newcastle fan, we are diametrically opposed. But it's a great community out there. Where the Geordies. Bill, nice work, my friend. Thank you very much indeed for that. Bill Mann, CEO of Motley Fool AM. Alexandria, Virginia, they've got a Newcastle supporters club. Hey, I've had an email.
Oh, hey, that's what.
And it's a really positive email, so I'm glad, because you know what I'm like. I'm like the Grinch, aren't I? This is from Richie Moyles, who writes in and says, actually, the UK economy may be in the doldrum, but people are spending on the joy of the season. You don't need to spend on the joy of the season, you've got me.
and I've got all the gifts in the office.
And a shout out to his company. It's called Balsam Hill, growing double digit this year. Yeah? That's great. Many people retreat to the comfort of their homes in times of uncertainty, enjoy the Christmas party. That's amazing. And I've just looked at what they sell. They sell Christmas trees.
Okay.
Got some lovely Christmas trees.
And you can, if you're a seller of Christmas trees, you can certainly make a pretty penny on them. They've
got a royal blue spruce, 20% off, down to £500. Have you got your trees up?
We do. Yeah, we do.
Good. Yeah.
I was shocked at how much they cost, though. So maybe that is going to be a boon to the UK economy.
Well, we've got the real one, and we've got the one we put up. That's in, because underfloor heating can't have the real one in certain rooms.
Oh.
What about the outside of the house? Have you gone for it?
We've got a wreath.
Nice.
Yeah,
nice.
I mean, we live in central London, so I was a little
it's going
nervous.
to get nicked if you put too much.
Exactly. I wanted to put more, but I'm not sure how it'll go over in our.
You've got to be careful.
Yeah.
Richie, thanks for that email. That's good. Positive email. I like it. Scorebox Europe. Not Score. That's the old email address. Steve.sedgwick at CNBC.com. You can send it to Scorebox Europe as well if you want. It will get through. That's great. Thank you. Happy Christmas.
Happy Christmas. We're going to take a quick break. We got a lot more coming up for you on this Friday morning, though. A whole new world for Disney as it announces an AI partnership with OpenAI. Plus, we dig into the latest in the Warner Brothers Discovery takeover battle, and we're stepping into Christmas and cracking open the chocolates as Carolyn speaks to the CEO of Leteract. That conversation is coming up at 7:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back to the program. A couple of big announcements from OpenAI yesterday. The company has introduced its new GPT 5.2 model, which it has described as its smartest AI product yet, with performance gains across key metrics. The release comes after CEO Sam Altman declared an internal code red, pushing to improve ChatGPT as it faces increasing competition from rivals, including Google's Gemini. CNBC spoke to Sam Altman, and he said he's confident OpenAI can lead the artificial intelligence race.
We have twice before seen a competitive threat, and I believe that when a competitive threat happens, you want to focus on it, deal with it quickly. We call that a code red, sort of a 6 or 8 week focus period, and then you deal with whatever you're going to deal with and get back to a position of clear leadership and move on. So that's what we're doing with Gemini. This is a pretty standard thing for us. I expect we'll exit it by January in a very strong position.
Disney will make a $1 billion investment in OpenAI and allow users to make videos with its copyrighted characters on the Sora app. As part of the deal, Disney will receive warrants to buy additional equity and use OpenAI's technology to build new tools and experiences. We're going to talk a lot more about both those announcements later in the show, but the CEOs of both Disney and OpenAI spoke to CNBC about the agreement, so listen to what they had to say first.
We've been mindful of the significant growth in AI to begin with, and extremely impressed with the progress that Sam and OpenAI have made. And that includes, by the way, as I said earlier, their agreement to both honor and value and respect our content. And we want to participate in what Sam is creating and what his team is creating. We think this is a good investment for the company. It's kind of a way in of sorts for us to appreciate even more what is obviously something that has significance in terms of the long-term impact on our business.
Disney, I think, is the greatest storytelling company in the world, bar none, and people really want to connect with Disney characters and express creativity in new ways. And we are confident from everything we've heard from our users that they're going to respond very well to being able to do this. And I hope that it'll unleash a whole new way that people use this technology and a new model for the companies making the technology and rights holders to sort of responsibly figure out how to get this done together.
Iger also spoke about the proposed takeover of Warner Brothers by Netflix and what it could mean for the sector.
If I were a regulator looking at this combination, I'd look at a few things. First of all, I would look at what the impact is on the consumer. Will one company end up with pricing leverage that, might be considered a negative or, damaging to the consumer, and with a significant amount of streaming subscriptions across the world, really, does that ultimately give Netflix pricing leverage over the consumer that it might not necessarily be healthy? Additionally, I'd look at what the impact might be on what I'll call the creative community, but also on the ecosystem of television and films, particularly motion pictures. That these movie theaters, which obviously run our films worldwide, operate with relatively thin margins, and they require not only volume, but they require interaction with these films and these movie companies that give them the ability to monetize successfully. That's a very, very important global business, and I think it's, we've been certainly participating in it in a very big way. We've had, I think, $33 billion films in the last 20 years, and we're mindful of protecting the health of that business. It's very important to the what I'll call the media ecosystem globally.
Oh, fantastic to get the view of Bob Iger there on what's going on with these Warner Brothers assets. Guy Petty joins us now, the founder of Fulcrum Media and former EVP for digital media at Paramount. Guy, great to have you with us. Thank you for stepping in here to give your take on what's going on with these assets. Let me kick off with the Netflix side of things, and then maybe we can get the Paramount side here. What is your take on what Warner Brothers assets, what these assets would mean for Netflix, how it would change the trajectory of Netflix from here if they are to emerge as the successful bidder here? And that's the status quo, it would seem, for now.
Yeah. Thanks for having me. With the Netflix, what Warner Brothers does for Netflix, it kind of gives them a fast forward of like 20 years of production with that Warner Brothers library, and which provides them a fantastic foundation of not only just the bulk catalog, but also the IP which they can then develop and produce additional content from. That's a really core asset. That's one of the big pillars of any of these major media companies. And of course, the other issue is the other big help is what their leadership in global distribution. They're pretty much in every country around the world where they're legally able to be there. They can actually give a leg up to help exploit and continue to grow the HBO Max brands.
Does Netflix need these assets?
I would think they do need the assets at some point in time. It takes a long time to build these assets by yourself. These assets take decades to build. There are only 6 libraries like this in the world, essentially. You've got Amazon now has MGM's library. Disney bought Fox's library. So you've got NBC Universal, Sony, Paramount, and Warner Brothers. And now Warner Brothers is in play. So they're very rare assets with a tremendous amount of value.
Guy, what do you think about the government getting involved and the Trump administration having a view on this one as well? Is it right that the government should get involved in this one, or actually should it just be left to competition authorities?
I think the government is always involved in it. There's always some sort of political angle on these large, high-profile mergers. I think in any country. I think the issue here is, with the current administration in the U.S., it's very transparent. Maybe too much transparency all the time. So I think that there's a lot of news, a lot of chatter, if you will. But I think the competition authorities are going to, analyze this merger, by either party, and properly do the analysis and see which areas are anti-competitive or have some competition issues, and go from there. Because the issue is going to be how narrow you define the market. And even President Trump in his last remarks yesterday basically said, well, we got to do the market analysis and and define and figure out if that's anti-competitive in the market. The issue is he just haven't decided what is not clear is, and it's not clear just for the U.S., it's going to be for every country involved, is what is the market? Is it narrow like SVOD, or is it something more broad where it's the engagement from other entertainment platforms, be it gaming, be it broadcast television, cable television, and of course you've got the streamers, which are both ad supported and then also subscription supported.
I just wonder, when I say the government getting involved, obviously saying is it uncompetitive or not. When your son-in-law is involved in one side of the trade, do you think they can be clear-eyed about this?
Oh, I think so.
Really? I'm sorry, this is the government, with respect to the government, and I'm not saying they've done anything illegal, where family ties and family investments, whether it be in the Middle East, whether it be in the media industry, there seems to be a lot of it going on the back of actually your father-in-law being the president. Do we think that you can be totally clear-eyed when this kind of stuff's going on?
Well, I sure hope so. I guess time will tell, but I would sure hope so.
Guy, let me just step in here and ask about the Paramount side of things. The same question I asked about Netflix, but I think for Paramount, perhaps it's a more interesting question: is where is Paramount left if they aren't successful with their latest hostile bid?
Well, I think Paramount needs scale. And they need scale on the two fronts where they can get the scale from. That is from the linear channels that Warner Discovery has to combine with their own linear channels, and also bringing in an HBO type service just on the subscription side to give them just more revenue and scale in that regard. From a library standpoint, it'll be one of the biggest libraries, if not the biggest library of that type of content around, which you can leverage it over time. But I think if they don't get that, they can still prosper. It's just going to be more difficult. It's just given their size. They're never. I don't think they're ever going to be able to get to that number one spot, number two spot, or number three spot. Now they've got great assets. They're solid assets, but again, you need that scale.